When company insiders put nearly $1 billion of their own firm's money on the line, it's time to pay attention. In September 2025, that's exactly what happened on the Singapore Exchange. Three of the region's biggest blue-chip companies made a massive $970 million statement, not with words, but with cold hard cash. This wasn't just routine trading. This was a powerful, coordinated signal of executive confidence, happening right in the middle of economic uncertainty. So what do these companies see that the rest of the market might be missing? And what does it mean for investors? Let's break it down. Disclaimer. This video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. When we hear the term insider buying, we often picture a CEO or a top executive making a personal investment in their company stock. And while that does signal personal belief, what we saw in Singapore is on a completely different scale. We're talking about corporate share buybacks, where the company itself uses its cash reserves to repurchase its own shares from the open market. Think of it this way. An individual executive buying shares is like a captain saying they believe in their ship. A massive corporate buyback is like the entire shipping company using its own money to buy back one of its own vessels, convinced it's the best investment they can possibly make. It signals that the highest level of leadership believes their stock is undervalued, and that reinvesting in themselves is the most profitable use of capital, more so than acquisitions or other investments. The three companies behind this nearly $1 billion move were banking giants United Overseas Bank, UOB, and Overseas Chinese Banking Corporation, OCBC, along with energy leader Sembcorp Industries. Each had a unique reason for deploying hundreds of millions of dollars, giving us a fascinating look into their strategy. Let's start with UOB, which made the biggest move with a $561 million share repurchase. UOB's leadership framed this as a direct result of their strong capital position. But digging deeper, it looks like a calculated defensive maneuver. In the first half of 2025, UOB's net profit actually saw a small dip of about 2.9%. At first glance, that might seem concerning. However, this wasn't due to poor performance. In fact, the bank's operating profit before allowances grew by a healthy 3.4%, and its cost-to-income ratio improved. The dip in net profit was mainly because the bank chose to be prudent, setting aside more money as preemptive provisions due to macroeconomic uncertainty. Essentially, UOB's management is sending a message. They're telling the market, don't get distracted by the short-term headline profit. Look at our core operational strength, our growing fee income, and our stable loan book. We are so confident in our long-term resiliency that we're using our fortress-like capital position to buy our own stock, even as some analysts are turning skeptical. This buyback is a powerful pushback against negative sentiment, intended to establish a valuation floor. Next, we have OCBC, which spent $349 million on buybacks as part of a larger, pre-announced $2.5 billion capital return program. OCBC's story is a classic case of what you might call valuation arbitrage. Like other banks, OCBC faced headwinds from falling interest rates, which squeezed its net interest margin, the key measure of its lending profitability. This pressure contributed to a 6% dip in net profit in the first half of the year. However, the market's focus on this cyclical issue has, in the eyes of management, created an opportunity. OCBC was trading at a relatively low price-to-earnings ratio of around 10.3 and a price-to-book ratio of 1.25. For a bank with incredibly strong fundamentals, including a very healthy non-performing loan ratio of just 0.9%, this is an attractive valuation. By buying back shares at this lower multiple, OCBC is effectively boosting its earnings per share and return on equity for all remaining shareholders. It's a smart, efficient use of capital. OCBC is effectively taking advantage of temporary market pessimism to maximize long-term shareholder value, all while its wealth management division continues to break records. Finally, there's Sembcorp Industries with a $59 million buyback. While smaller, this move is arguably the most strategic. Sembcorp is in the middle of a massive transformation, pivoting from traditional power generation towards renewable, green energy. This is a high-stakes, capital-intensive transition. In the first half of 2025, the challenge of this pivot became clear. The company's legacy gas division saw profits dip slightly, hit by a sharp 39% drop in Singapore's wholesale electricity prices. But at the same time, its renewable segment, the future of the company, saw profits surge by an impressive 27%. The $59 million buyback acts as a stabilizing force. It tells investors that management is confident in its cash generation, even with volatility in the old business. By repurchasing shares and simultaneously raising its interim dividend by 50%, Sembcorp is reinforcing the market's trust. It's a clear signal that the green transition is on track and that the company has the financial strength to both fund its future growth and reward shareholders today. So, what are the key takeaways for investors? We see three very distinct signals, each with its own set of opportunities and risks. First, OCBC represents the clear value play. Its buyback at a low valuation signals that management sees a significant disconnect between its stock price and its intrinsic worth, especially given its rock-solid asset quality. The opportunity here is a potential re-rating of the stock as the market looks past the temporary margin pressures. The primary risk, however, is that a low interest rate environment persists longer than expected, further weighing on profitability. Second, UOB is the resilience play. The buyback is a testament to its fortress balance sheet and operational discipline. For investors who prioritize stability and a strong regional franchise, UOB's signal is one of enduring strength. The risk lies in its higher valuation. Trading at a premium, the stock needs to deliver consistent execution to justify its price, and a prolonged economic slowdown could test that resilience. And third, Sembcorp Industries is the growth through transition play. The buyback validates its strategic pivot to renewables. This is for investors with a long-term horizon, who believe in the global energy transition and trust management's ability to execute. The risks are twofold: execution risk in hitting their ambitious renewable capacity targets, and market risk from continued volatility in the legacy energy business. In conclusion, the $970 million in share buybacks across these three Singaporean blue chips is far more than just a footnote in the financial news. It is a calculated, powerful statement from corporate leaders. They are collectively signaling that despite near-term headwinds like interest rate shifts and volatile energy prices, they believe their companies are fundamentally undervalued. By deploying their own capital, they are not just expressing confidence, they are actively investing in it, turning market skepticism into a strategic opportunity for long-term value creation. We hope this breakdown was insightful. If you found this analysis helpful, please consider liking this video, sharing it with others, and subscribing to our channel for more content. Thank you for watching.